So what are the risks that bondholders take? So if I were to buy a bond, what type of risks am I facing? Um, we are going to talk about liquidity risk, default risk, and interest rate risk. Liquidity risk is the simplest. You buy a bond. What if you were not able to sell it back? What if nobody's buying? There is no market, like New York Stock Exchange or NASDAQ, that bonds are traded and you are basically selling it back or buying it from your broker, and your broker may be matching it internally in-house with another client of the same company, or you may be buying it from wholesale where your broker company is working with a bigger broker in a way, or ultimately you may be buying from the underwriter. So the issue is when you buy a bond, you may not be able to sell it back. So that's referred to as liquidity risk. Some bonds inherently don't have any liquidity risk. For instance, very short-term U.S. Treasuries are considered to be risk-free. That is default, liquidity, and interest rate risk, because they're very short-term and because they are very, very liquid, and because U.S. government never defaulted. So some bonds are inherently risky with respect to liquidity, and these you may actually buy the bond and you may not be able to sell. And because if you need to sell, because it has a low liquidity, you may have to drop down the price. So you buy a bond, say for $900 when the face value is 1,000, you may have to sell it at 850, 800, 750, 700, and so on and so forth. If it has no liquidity, and depending on how desperate you are to sell the bond, you may have to discount the bond. So that's what liquidity risk refers to. Default risk is what if the company doesn't pay? That's it. And it's a very real risk. The companies issue bonds every day. Anybody can issue a bond. And if they issue a bond and they cannot pay, well, they're at a default. You may have to go through bankruptcy proceedings, liquidation proceedings, legal channels of getting your money, but it really is not fun. So having a default risk is really, really risky. So we look for issuers that have as little default risk as possible. However, you can never know for certain. So for instance, Apple seems to be a good company, seems to be very low on default risk. They have almost $300 billion in cash. How risky could they be, right? But let's say that you wanted to buy a 30-year bond from Apple. Well, then you don't know what sort of financial situation Apple will be in 30 years from now. If you think about it, years ago, BlackBerry was a great company and great phone, but then iPhone came along and they wiped them off. So right now, BlackBerry is a very financially tight situation, to say the least. So the default risk, as the maturity increases, obviously will have predictability issues with the amount of default risk that you're being exposed to. Now, the interest rate risk is very specific. So let me actually show it to you through a spreadsheet. So let's say that the current price for the bond is, say, $900, and then your face value is $1,000. Now, your net return, or net income, if you want to call it that, is literally your face value minus the current price, $100. Your net yield is $100 return that you earn on a $900 investment. So it is approximately 11%. Now, if you're going to hold the bond until the maturity, your interest rate risk may not be, well, how should I say it? So think of it like this. We all want to have the highest possible return. However, if you buy this bond, you buy it, and right now it is at 11%, and you're okay with it, you're happy with it, and you got yourself locked into this. If you keep this bond until the maturity and the company does not default, you're going to get your $1,000 face value and you're going to earn your 11%. The company honors its promise, pays you the $1,000 face, and you earn your 11%. That's it. However, in the meantime, while you're holding this, interest rates may change. Let's call this bond early. And then let's call this bond later. So on the bond early, we buy this, and that's our situation. With the bond later, let's say that this still has the same $1,000, but this time the interest rates went down, which means that now the same bond is selling for $950. Now notice, you're going to have a $50 return and the yield will be 526. Now, this is the one that we own. Well, we bought it at $900 and we're making 11%. Fantastic. So we don't really have to feel bad that interest rates went down and the same bond is now trading at a $950. In fact, we could sell this specific bond that we bought at $900 at $950 and realize a $50 profit. Now, we are feeling pretty good about this. On the other hand, if interest rates were to go up, and let's say that the same bond was trading at $800, now we feel pretty bad, because what we paid $900, the very same bond, because interest rates went up, is now trading at $800. Now, we would have made $200 profit on this one, and we could have earned 25% return, but we paid $900 and are earning 11%. So we feel pretty bad about this. We lost on the opportunity cost. Now, notice, if you're holding this until the maturity, all we're losing is the opportunity cost, alternative cost. We could have made more money. We could have lost money. We could have made more money. So that, if you're holding it until the maturity. However, if your intent was always keep the bond for a few years and I'm going to sell and get out, well, then now you are at a tight spot, because you bought it at $900. You were hoping to make 11%, but now that bond is trading at $800 and you literally lost money. Again, if you hold it until the maturity, you will earn your 11% and you were okay with it to begin with. So everything is fine. However, if your intention was to keep it for a few years and then get rid of it, and hoping to make a few dollars of a profit in the price change, and in the meantime interest rates go up, well, now the same bond is trading at $800 and you just lost money, real money. If you hold it until the maturity and this happens, you only lose opportunity cost. So you don't lose real money. You lose opportunity cost. However, if you were to buy it at a $900 and want to get rid of it after some time, now you're selling the same bond at $800 in the market and you lost $100. So that is referred to as the interest rate risk. If you hold your bond until the maturity, you have only default risk, which is a real risk. Liquidity risk and interest rate risk applies as an opportunity cost. However, if you're holding it, or if you bought a bond with the purpose of selling it after some time, but definitely before its maturity, then you are exposed to the liquidity risk and interest rate risk. So these are the risks that bondholders take, or these are the primary risks that bondholders take when you're investing in a bond.